I'm going to present about financial instruments. So what is financial instrument? So financial instrument is a contract that gives price to a financial asset of an entity and financial liability or financial equity instrument of another entity. This definition itself describes that financial instrument as contract. Therefore, in essence, financial asset, financial liability, and financial equity instruments are going to be pieces of paper. So these are the example of the three components of financial instruments, which are asset, liability, and equity components. So firstly is issuance of share, which is the equity components of the financial instruments. The entity that subscribes to the share has a financial asset, which is an investment. Meanwhile, the issuer of the shares who raise financial has to account for an equity instrument, which is equity share capital. Secondly is issuance of bond, which is the liability components of the financial instrument. So the entity that subscribes to the bond has a financial asset, is an investment. Meanwhile, the issuer of the bond has to account for the bond as the financial liability. Lastly, subscription of financial instrument issued by other entity, which is the asset component of the financial instrument. For example, when an invoice is issued on sale of good on credit, the entity that has sold the good has a financial asset, which is receivable. So to make things simple, financial instrument is the way how we account the investment in share, which is equity, investment in bond, which is liability, and receivable, which is asset. So moving on, let us know what is the history behind the phase of completion of IFRS 9. So on November 2009, IASB issued IFRS 9 financial instruments as the first step in its project to replace IAS 39 financial instruments. Recognition and measurement. So IFRS 9 introduced new requirements for classifying and measuring financial assets that had to be applied starting 1 January 2013 with early adoption permitted. On October 2010, IASB reissued IFRS 9 incorporating new requirements on accounting for financial liabilities, carrying over from IAS 39 the requirements for the recognition of financial assets and financial liabilities. On December 2011, IASB issued mandatory effective date and transition disclosure with amendment to IFRS 9 and IFRS 7, which amended the effective date of IFRS 9 to annual period beginning from or after 1 January 2015 and modified the relief from restating comparative periods and associated disclosures in IFRS 7. On November 2013, IASB issued IFRS 9 amending IFRS 9 to include the new general hedge accounting model, allow early adoption of the treatment of fair value changes due to own credits on liabilities designated at fair value through profit or loss, and remove the 1 January 2015 effective date. Lastly, on July 2014, IASB issued the final version of IFRS 9, incorporating a new expected loss impairment model and introducing limited amendment to the classification and measurement requirement for the financial asset. This version supersedes all the previous version and mandatory effective beginning 1 January 2018. And now, I'm going to pass the presentation to Aina Najihah.
Hi, my name is Aina and I will explain to you about business model. So business model refers to how an entity manages its financial assets in order to generate cash flows. So business model is not applied to financial instruments on an individual basis, but rather it is applied in an aggregate manner for investment portfolios. This means that the financial instruments that are similar are gathered into one portfolio. So we treat it as a whole, not as an individual. So why we need to determine the business model? Because we need to determine the business model within the financial instruments in order to decide the appropriate classification category under the IFRS 9. So, the financial instruments under business model are classified based on the way the entity manage them. It is whether the portfolio is managed in accordance with its collection of contractual cash, or it is managed with the objective of selling them in the future. Also, the portfolio can be the both to collect the contractual cash and to sell them. So let me explain it further. Let's look at the first one. First is the entity hold the financial assets to collect the contractual cash flow rather than with a view to selling the assets to generate the cash flow. So it is managed to realize the cash flows by collecting the contractual payments over the life of the instruments. For example, is the trade receivables. So the trade receivables, the entity sells the goods to customers in credit. So and typically offers the customers up to 60 days following the delivery of goods to make payment in full. Therefore, the entity collects the cash in accordance with the contractual cash flows of the trade receivables and has no intention to dispose of the receivables. Okay. However, there is no requirement that the financial assets are always held until their maturity, and IFRS 9 identifies some sales that are considered consistent with the hold to collect business model irrespective of their frequency and significance. This is in contrast to the held to maturity category under IAS 39, which penalize entities for sales in all but exceptional circumstances. Nevertheless, it is expected that sales would be incidental to this business model, and consequently, an entity need to assess the nature, the frequency, and significance of any sales occurring. Next is let's take a look at the meaning of hold to collect and sell. So under the hold to collect and sell business model, the objective is to both collect the contractual cash flows and sell the financial asset. In contrast to the hold to collect business model, sales are integral or significant rather than incidental, and consequently this business model typically involves a greater frequency and volume of sales. One example would be government or corporate bonds that are held with the dual objective of holding those bonds to earn interest and selling those bonds before their maturity in order to generate cash for investment or liquidity purpose. There are three accounting treatments of the financial instruments that are notably reflected in the term of the classification, namely, first is the fair value recognized through profit and loss. It is for the intent to sell objective. Second is fair value recognized through other comprehensive income. It is for the intention of both objective, to collect contractual cash and also to sell. And last is the amortized cost. It is for the objective to collect the contractual cash. Now, let us take a look of example 6.1. So example 6.1 is about an entity has a portfolio of the financial assets and it is managed with the objective of collecting cash arising from the instrument. However, a financial asset will be sold if the credit ratings of the issuer's instrument fall to a level below of what is regarded as a safe investment by the management, and the sale of the financial assets that do not meet the requirement of a safe investment is not frequent, and it is expected that the volume that the large volume of sales would be occurring soon. So we need to determine what is the business model for this entity. So in this example, it is clearly stated that the portfolio is managed with the objective of collecting cash arising from the instruments. It is not for the entity to gain changes in the instrument's fair value in the future. Even though there are conditions that makes the financial assets will be sold, it is not frequent and the volume is insignificant. Therefore, the business model for this entity is to hold the financial assets with the objective of collecting the cash from the instruments. And the accounting treatment for this objective is we amortize them. Next is example 6.2. So example 6.2 is about the entity holds a short-term financial asset in a portfolio with the objective of obtaining funds for a capital expenditure. So once the financial asset reach their maturity, the entity would sell the financial asset and reinvest the cash in another short-term financial asset. So this strategy is continuously repeated until the funds are eventually gathered in time for the capital expenditure. So we need to determine the business model for this entity. In this example, the entity has the objective to collect cash arising from the investment in the instrument. This is because the entity holds the short-term financial asset to obtain the funds for a capital expenditure that will occur in the next 5 years or so. Even if there are a number of selling that take place, which is the entity would sell the assets once it reached their maturity, it does not deter the entity's main objective of holding the financial assets so as to collect the contractual cash resulting from the instruments. Where sales occur that are more than infrequent and that are more insignificant in value, an entity will need to assess whether and how those sales are consistent with the objective of a hold to collect business model. So the accounting treatment for this example also is amortized cost. And last example for the business model is example 6.3. This example is like example 6.2. However, in this example, the entity holds the financial assets only until opportunity arises in which the financial asset will be sold and reinvest in other financial assets that yield higher return. So we need to determine the business model for this. For this example, the objective of the entity holds the financial assets are both, which are to collect the contractual cash as well as selling the financial assets. This can be proved by the entity's action to sell the financial assets in order to get the higher return. The entity needs to use their professional judgment to assess their business model in order to maximize the amount of cash gathered to meet the need for a capital expenditure in the future. So they need to decide whether to hold or sell the financial assets. And the accounting treatment for this is fair value through other comprehensive income.
Hi everyone, so for my turn, I will explain about cash flow characteristic. As Aina mentioned just now, one of the way to classify the financial assets is by using business model. So the other way is by using cash flow characteristic. So as we can read here, Paragraph 4.1.2 of the MFRS9 standard stipulates that the cash flow from a financial instrument should actually represent the principal and the interest of the financial instrument. The cash flow should not encompass elements other than these two, principal and interest component. In short, the cash flow characteristic must only contain the principal and interest element. These cash flow characteristics are widely known as solely payments of principal and interest as PPI. Application guidance in section B4 of the MFRS9 standard further describe the principal and interest elements. According to this section, principal is explained as the fair value of the instrument at the initial recognition. Meanwhile, the interest rate is summed up as the time value money relating to the instruments, and therefore is not comprised of any risk except for credit risk, liquidity risk, and other risks that are not inherent in basic lending arrangement and costs associated in holding the financial instrument. The cash flow characteristic generally consider the nature of the cash flows arising from the respective financial instruments. In principle, to fulfill the cash flow characteristic, the cash flow needs to contain only a principal and interest element as per time value of money concept. This is illustrated in the following example. So that is the definition of cash flow characteristic. And now we want to look at the examples, the two examples 6.4 and 6.5 about cash flow characteristic. Okay, let's start. At first, when I read this question, I am totally blurred because maybe of some words that I don't understand at all. When I try to study and research and Google more about the words that I don't understand, so here I come out with 4 steps that I think become easy for us to understand and solve this question. Okay, so as you guys can see here, let's look at the solution. Okay, so the first one, in the example, the cash obtained from the instrument is derived from the payment of principal as well as the interest. The issue is whether the payment for the interest relates to the elements of time value of money only for the component to be regarded as interest. That the statements is actually explain to us that if you guys still remember, I see this just now, cash flow characteristic have need only to have these two things, which is the principals and the interest. So for this question, the principal is settled already. So the issue now is we want to know, is that the interest relate to the time value of money or not? If the interest relate to time value of money, so it is cash flow characteristic, and if not relate to interest, so it is not cash flow characteristic. So the first step is why we need to relate with the time value of money, because let's see here. Application guidance in section B4 of the MFRS9 standard describes interest rate is summed up as the time value money relating to the instrument. These statements is about the interest and the time value of money. And if we don't know what is time value of money actually is, what is the meaning? So, time value of money is based on the idea that people would rather have money today than in the future because of money's potential to grow in value over a given period of time. For example, money deposited into a savings account earns a certain interest rate and is therefore said to be compounding a value. Means that 100,000, if you save 100,000 is like so big. If we save 1,000 1,000 in 2020 is not same if we save 1,000 in 2023. Like that. So it is more worth when we save now. Rather than we save in future. It is worth if we save 1,000 now. If we save 1,000 now rather than we save 1,000 in 2023. Okay, so settle for the first step. Okay, for the second step, we refer to the statement of subject to the inflation index of the currency of the issued instrument. So here, if you guys can see the word inflation, we need to understand quite good about inflation. So here I will share what is inflation actually and what is inflation index. So in the example, in the question, the interest is linked to the inflation index. So what is inflation? What is inflation actually? Inflation is the rate at which the general level of prices for goods and services is rising, and consequently the purchasing power of currency is falling. Ideally, an optimum level of inflation is required to promote spending to a certain extent instead of saving, thereby nurturing economic growth. Hence, inflation index is a tool used to gauge general price changes in an economy over time. So, actually, inflation and interest is a vice versa. If interest is low, so inflation will be high. Okay, if you guys want to know more about inflation, so it will become more longer. So here, just understand that when interest is low, so the inflation is high, or like just vice versa. If the inflation is high, so the inflation is low. So why? Because of why? That one, I think I will not explain. But just remember the vice versa one. Interest high, inflation low. If interest low, inflation is high. So let's see the third. So let's see the third step. The third step is the third statement from the question. So the third one is the inflation index is not leveraged. So what is actually not leveraged? So we understand just now, inflation index is like the level for the inflation. Inflation index is like the level for the inflation. So what is leverage actually, and what is leverage and what is not leverage? So here, as we can see here, we read from here. The basic definition for leverage is the mechanical advantage available, such as we borrow capital for an investment, expecting the profits made to be greater than the interest payable. So, in this case where it is not leverage, okay, let's see. If leverage is just like we borrow capital from the bank, and we expect we can get more profits. We can get more profits lah. So leverage actually means actually in simple words, like I understand, if you guys if we borrow money from the bank, so there is interest, right? So when there is the interest, it is not fixed. It's not fixed interest. So why the interest change? Because of the inflation. If the inflation change, so the interest will also change. And that is leverage. Leverage is like you borrow the money from the bank. So if it is not leveraged, means that you don't borrow money from the bank, so you don't have the factor of the inflation, right? Because you don't have any relationship with the bank, so there's no other elements. Thus it is only have the elements of time value of money, which means if in the 5 years you will get interest 10,000, so it is true. Okay, and so let's see at the timeline, I think. So we can see here, if there is leverage, so we cannot expect that. Okay, we cannot expect that if we think that we will get interest for 10,000. So it is not sure, or it is not confirmed that at the end of the year we will get 10,000 interest if it is leveraged. And if it is not leveraged, so if we think that our interest is 10,000, so it is confirmed that at the end of the year we will get 10,000. You can see the difference. So to make it short, if the inflation index is leveraged, it means that there will be another elements which we don't want that elements. And if the inflation index is not leveraged, it means that the elements only have the principal and the interest, which the principal and the interest is the element that can be categorized as cash flow. Okay, so the last step is just like the final one is, like you can see here, it doesn't not constitute other elements, and therefore is related to time value of money, resulting contractual cash flow from the instrument is this reflecting the payment for the principal and the interest. So as we can see, when the interest is related to the time value money, a time value of money concept, so it is the cash flow characteristic. Okay, that's all for example 6.4. Okay, so how about example 6.5? Let's read the question first. Okay, this example retains similar details as per example 6.4. However, instead of linking the interest to the inflation index of the instrument's currency, the interest is linked to another variable that is based on the issuer's financial performance, net income. For example, it's net income. So, just remember like this. So we need, if we want to categorize the thing as the cash flow characteristic, we will make sure we will consider the principles and the elements and the interest. So for the interest, it must be relate to the time value of money concept. So for net income, is that relate to time value of money concept? For example, you cannot say that for me, net income is not relate to the time value of money concept. Because of what? You cannot say that your income 2020 is 5,000 is like your another 3 years, like it is not related to the time value money of concept unless you save the money in the bank. So if you save your income, your income 5,000 in the bank now, and at the end of 2023 the money will be increased. So if you save in the bank, so it will be another case. For this, just your income, you cannot say it is related to time value money of concept. So the word for the statement for the solution we can refer here. In this circumstance, it is evident that the interest is based on an element not related to the time value money of concept, time value of money concept. Hence, the payment from the resulting cash flow does not reflect the payment for principal and interest net income. It is not related for any principal and interest unless you save it in the bank. So it will be related to the interest. So, for example 6.5, it is not cash flow characteristic, and for example 6.4, it is related to the cash flow characteristic. So that's all from me. Thank you.
Hi guys, now I'm going to present on the types of financial instrument, where there are three types of financial instrument, which are financial asset, financial liability, and financial equity. So first, let us look at financial asset. So financial asset is any asset that is a cash, an equity instrument of another entity, a contractual right where there is a right to receive cash from another entity, and also the right to exchange financial asset or financial liability with another entity with conditions that are favorable. So favorable here means that the entity is expected to earn some profit from the exchange. And lastly, a contract that may be settled in entity's own equity instrument, where the entity is obligated to receive a variable number of entity's own equity instrument. So for this last point, I'm going to give an example. So for example, company X owes 50,000 ringgit from Y, and then company X don't have enough cash to pay the debt, so they decided to pay using its own equity instrument. So let's say they use shares. So company X will make an agreement with Y that they will settle the debt by issuing shares amounting to 50,000 ringgit. So in this situation, Y is obligated to receive a variable number of company X equity instrument. So Y will record this as financial asset. So next we will go to financial liability. So financial liability here is any liability that is a contractual obligation, where there is an obligation to deliver a cash to another entity, and also obligation to exchange financial asset or financial liability with another entity under conditions that are unfavorable. So unfavorable here means that the entity is expected to face loss from the exchange. And lastly, a contract that may be settled in entity's own equity instrument, where the entity is obligated to deliver a variable number of entity's own equity instrument. So let's use the example that I gave just now, where company X owes 50,000 ringgit from Y and decided to pay using its own equity instrument, which is 50,000 ringgit worth of shares. So in this situation, company X is obligated to deliver a variable number of entities own equity instrument. So company X will record this as financial liability. And lastly is on the financial equity. So as you can see, for financial asset, there is an obligation to receive a variable number of entities own equity instrument, while in financial liability, there is an obligation to deliver a variable number of entities own equity instrument. So in financial equity, there is no obligation to deliver cash to another entity, which we will discuss further in the next slide. Now let us look at the financial equity. So what is financial equity? Financial equity can also be known as equity instrument. In order for the instrument to be classified as a financial equity, it must first pass fixed for fixed test, which I will explain in details later, and the entity has no obligation to deliver the cash to a third party. Examples of financial equities are ordinary shares, reserves, and preference shares non-redeemable. So preference shares non-redeemable here means that the entity has no contract to buy back the shares from their investors. if the entity has contract to buy back the shares from their investors, then it will be called as preference shares redeemable, which will be classified as financial liability. So what is fixed for fixed test? Fixed for fixed test is a situation where a company exchanges a fixed number of its own shares for a fixed amount of cash or other financial assets at a fixed date. It is settled by entity receiving or delivering a fixed number of its own shares for no future consideration, which means that the entity has no obligation to deliver the money to another entity. So now let's look at the example. So for example, company Lee has a financial liability of 20,000 ringgit towards Kim and has an agreement to settle it with 1,000 shares from company Lee's own shares. So here means that company Lee owes Kim an amount of 20,000 ringgit, and then they have made an agreement that company Lee will settle it with 1,000 shares. So the financial liability amount is fixed at 20,000 ringgit and the settlement will be a fixed number of shares, which is 1,000 shares. Therefore, it has passed fixed for fixed test. So company Lee will record it as debit payables since company Lee has settled its debt of 20,000 ringgit, and credit ordinary shares since Kim now has become company Lee's new shareholder. And please take note that if the amount is variable, it will be classified as a financial liability. So now let us look at the example 6.6, which is on the issue of shares. This example is adopted and adapted from example 6.4 in chapter 6 of Part 1 first edition. So the question says that Shiny Berhad issues 500,000 shares with a par value of 1 ringgit each. So this value 1 ringgit we will use to calculate share capital at the price of 2 ringgit and 50 cents payable in full upon application, and this amount we will take to calculate the total shares collected. The shares are fully subscribed with all the application money received. The cost of share issue is 70,000 ringgit. This 70,000 ringgit is the incidental cost, which here is the legal fees, and it will be expense off. So for share capital, we will take 1 ringgit, and for share premium, we will take the difference between 2 ringgit and 50 cents and 1 ringgit. So it will be 2 ringgit and 50 cents. So for solution, how to know that whether we can classify it as financial equity or not? We can ask, does the issue of shares pass fixed for fixed test? So firstly, Shiny Berhad issued a fixed number of their own shares, which is 500,000 shares. And secondly, Shiny Berhad also has received a fixed amount of cash from the other entity, where the question says that the shares are fully subscribed and all application money has been received. And lastly, we can ask, does the entity has an obligation to deliver the money received to another party? No. In this situation, Shiny Berhad does not have an obligation to deliver the money received to another party. So in conclusion, Shiny Berhad can record this as a financial equity. As for calculation, to calculate the total shares collected, we will use the 3 ringgit and 50 cents, while for share capital, we will take 1 ringgit. And the difference between these two, we will use to calculate share premium. And the incidental cost, which is 70,000 ringgit just now, we will deduct it from total shares collected and also from share capital. So lastly, the total shares collected will be 1,680,000 ringgit. For share capital, 430,000 ringgit, and share premium 1,250,000 ringgit. For journal entries, it will be debit cash, which is the total shares collected, credit share capital, and credit share premium. For the incidental cost, it will be expense off, where we will debit issue cost 70,000 ringgit and credit cash 70,000 ringgit. So that is all from me. Now we will proceed to the next presenter.
my name is Aina Idina. So now I will proceed with example 6.7. Example 6.7 is basically the measurement of financial asset at amortized cost. So here's the question. Desaru Berhad purchased 10,000 units of bond in Zaila Berhad on 1st January 2021. The nominal value of the bond would be Rm100 ringgit for every unit, and the transaction cost for the bond purchase total Rm15,000. Zaila Berhad pays for the coupon rate for the bond at 6% payable annually, and the last payment for the coupon interest rate from Zaila Berhad would be on 31st December 2026. The market interest rate for the bond with the similar risk is 7%, and the effective interest rate would be 5.70%. So the requirement for this example is, under the amortized cost model, what will be the amount of the investment reported on the statement of financial position of Desaru Berhad, assuming that Desaru Berhad financial statement ends on 31st December each year. Note that the purchase of bond made by Desaru Berhad is an investment of debt instruments. Before we proceed with the solution, we will look at some important definition related to this example. The first one is the amortized cost. The amortized cost is the amount at which the financial asset or the financial liability is measured at its initial recognition and then minus with the principal repayments, and then plus or minus with the cumulative amortization by using the effective interest method of any difference between the initial amount and the maturity amount. And for the financial asset, it is adjusted for any loss allowance. Next, for the effective interest rate, the effective interest rate is the rate that discounts or deducts the estimated future cash flows throughout the expected life of the financial instrument to the gross carrying amount of the financial asset or to the amortized cost of the financial liabilities. Meanwhile, the effective interest method is the method that is used in the calculation of amortized cost in the financial instrument, and also in the allocation and recognition of the interest expense or revenue in profit or loss. And the last one, the gross carrying amount. The gross carrying amount is the amortized cost of a financial asset before it is adjusted for any loss allowance. Before we proceed with the calculation for example 6.7, we must know what type of financial instrument for the purchase of bond made by Desaru Berhad, and also the reason why the purchase of bond made by Desaru Berhad is classified to be subsequently measured under the amortized cost model. So the first one is the purchase of bond is a financial asset to Desaru Berhad, who receive cash payments for interest income every year from the bond issuer Zaila Berhad. So the next one, for the classification, for your information, IFRS 9 financial instrument has introduced a number of new measurement categories, while eliminate some of the previous categories under IAS 39 financial instrument measurement and recognition. So under IFRS 9, a financial asset are classified into one of the four categories, which are, the first one is the amortized cost, and the second one is the fair value through other comprehensive income on certain debt instrument and on certain equity investment, and the last one is the fair value through profit and loss. So basically this purchase of bond is subsequently measured at amortized cost, and it meets the following criteria, the two criteria. So the first criteria is the hold to collect business model criteria. So basically, the asset is held within a business model whose its objective is to hold the asset in order to collect contractual cash flows from the financial asset, rather than with a view to sell the asset in order to realize a profit or loss. Then it is not mentioned in the example whether Desaru Berhad want to sell the bonds at any period of time, so we can say that Desaru Berhad will hold the asset until the maturity date on 31st December 2026.
So the second criteria is the asset must meet the SPPI contractual cash flow characteristic test. So basically, contractual cash flows are considered to be SPPI if the contractual terms of the financial asset only give rise to cash flows that are solely payment for principals and interest on the principal amount outstanding on the specified dates. Looking at the calculation for example 6.7, there are two steps, the initial measurement and the subsequent measurement. So firstly, the initial measurement. For any initial measurement for financial instrument, the financial instrument will be measured at the fair value, and it shall include the amount of the transaction cost, which is the incremental cost that is directly attributable to the acquisition, issue or disposal of the financial instrument. So from example 6.7, Desaru Berhad had purchased 10,000 units of bonds, and the price for each of the bond is RM100 ringgit. So we will multiply the RM100 ringgit with 10,000 units of bond to get the price of the bond, and the price of the bond is RM1 million. As it is in the initial measurement for financial asset, we will include the transaction cost, which is RM15,000 ringgit. So basically, the payment of the bonds that made by Desaru Berhad to Zaila Berhad is RM1 million and 15,000 ringgit. Next, for the subsequent measurement, we know that we will measure the financial asset by using amortization cost method, and it is mentioned in the example that Desaru Berhad will be receive interest income every year, which was the coupon rate at 6% as promised by Zaila Berhad. So to calculate the amount of the amount of interest income that they will receive each year, so they get the 6% times with the RM1 million, which is the price of the bond, and the interest income that they will receive each year is 16,000 ringgit. Desaru Berhad will be receive the interest income from 31st December 2021 until the maturity date 31st December 2026. It is also mentioned that in the last coupon interest payment, Zaila Berhad will pay the face value of the bond, which is the price of the bond RM1 million ringgit, and it includes the annual interest income that Desaru Berhad receive, which is 60,000 ringgit. So basically, the amount that Zaila Berhad have to pay at the maturity date is RM1 million and 60,000 ringgit. Then, looking at the timeline here, we can see that the cash flows in the Desaru Berhad. In the 1st January 2021, it is in the negative amount to indicate the cash outflows from Desaru Berhad, as they made the payment to purchase the bonds from Zaila Berhad. And then from the 31st December 2021 until 31st December 2025, they will receive the annual interest income, which is the 16,000 ringgit. And at the end, the 31st December 2026, the maturity date, they will receive the face value of the bond, which is RM1 million and 60,000 ringgit, as per explained in the subsequent measurement before. This slide here, we will calculate the effective interest rate by using the IRR function in Excel. So example 6.7 is about the measurement of financial asset that is measured at amortized cost. So as I mentioned in the previous slide before, amortized cost requires the use of effective interest rate method. And it is also mentioned in the example 6.7 that the effective interest rate is 5.70%. So by using the IRR function in the Excel, we will get the 5.70% in the accurate number that we want. For example, if we want it in 4 decimal places, we can simply calculate it by using the IRR function in the Excel. So how to do it? From the picture here, firstly, we should set, we want to get the answer of the effective interest rate in 4 decimal places. And then we will put all the information related to the transaction that happened in Desaru Berhad. So firstly, we will enter the first one, which is the date where the payment of the bond was made, which is RM 1,050,000 ringgit, and it is in negative amount. And then we will proceed with the 31st December 2021 until 31st December 2025. We know that Desaru Berhad will receive the interest income 60,000 ringgit annually from Zaila Berhad. So we put 60,000 ringgit from the 31st December 2021 until the 31st December 2025. And then, as mentioned in the example, on 31st December 2026, Zaila Berhad will pay the face value of the bond, which is RM 1,060,000 ringgit, which is in positive amount, as it is a cash inflow for Desaru Berhad. And then that's all the information. And then to calculate the effective interest rate by using the IRR function, firstly we will put the equal sign at any cell under the information above there. So, and then we put the equal sign. After that, we'll put the IRR on capitals, and then we'll put the open bracket, and then we will put the number of cells that contain the first information that happened. For in example in here, the date where the payment for the purchase of the bond was made, which is negative RM 1,015,000 ringgit. So RM 1,050,000 ringgit is in C3, and then we put C3 there beside the bracket, and then we put the colon. After that, we put the last information in related to the example, which is RM 1,060,000 ringgit. So RM 1,060,000 ringgit is on cell C9, and then we put C9, and then we put the close bracket, and we press the enter, and then we will get the effective interest rate in 4 decimal point, as we set it in the earlier. So the effective interest rate that we will get is 5.6978%. Lastly, in order to determine the carrying amount of the amortized cost, a bond amortization schedule is prepared. So in this table, there are 4 main sections, which are, the first one is the opening balance, and we will note the opening balance with A. And then the second one is the interest income at the effective interest rate, which that we have calculated in the previous slide, which is 5.6978%, and we will note this as B. And then for the third section is the expected cash flow from the interest received from Zaila Berhad at 6%, and we will note this as C. And the last one is the closing balance, and we note this as D. Firstly, we will put the information for 1st January 2021, and we put the value of the bond purchase at the 1st January 2021, which is RM 1,015,000 ringgit on the opening balance. There is no interest received during the payment was made, and so we will proceed to the closing balance of the 1st January 2021. The closing balance for 1st January 2021 will be the same as the opening balance for 1st January 2021, which is RM 1,015,000 ringgit. And then proceed to 31st December 2021. For the opening balance on 31st December 2021, it is RM 1,015,000 ringgit from the closing balance of the 1st January 2021. And then to calculate the interest income at the effective rate of 5.6978%, we need to multiply the 5.6978% with the opening balance, which is RM 1,015,000 ringgit. And the same calculation can be applied to each year from 31st December 2022 until 31st December 2026 to get the interest income at the effective rate. And then with the Expected cash flow from the interest received from Zala Berhad is RM60,000 and it is the same amount from 31st December 2021 until 31st December 2026. After that, the last one, to calculate the closing balance, firstly, the interest income from the effective interest rate will be added to the opening balance. Note that the interest income from the effective interest rate is the actual interest received for the bonds. And after that, we will minus the calculation with the expected cash flow from the interest received from the Zala Berhad, which is the 60,000, and then we will get the amount for the closing balance. So basically, we already know the section as A, B, C, and D. So the formula will be B equals to A plus B minus C. Basically, the bonds are subsequently measured by using the same approach for the each year, and then this would give rise to the carrying amount of the bonds on the Saru Berhad financial position on each year. That's all from me.
Hello and good evening everyone. As for today, I will explain a little bit about fair value through profit and loss as well as fair value through other comprehensive income. First of all, for fair value through profit and loss, it means that at each balance sheet date, the financial asset or financial liability will be measured at fair value, and then the changes to the fair value will be recorded into the profit and loss. The financial instrument, financial asset or financial liability will be measured at fair value through profit or loss if the company have intention to sell it. They have a trading objective of selling, in which, for instance, when a company purchase a bonds and then they want to sell that bonds before their maturity period, so that means the company have intention to sell it, so that it will be measured at fair value through profit or loss. Besides that, for fair value through other comprehensive income, the financial asset or financial liability will be measured at fair value through other comprehensive income when the company have both objective, which is to collect contractual cash flow as well as to sell it in the future. When they have both intention, the changes that they get after measure it at fair value, the changes to the fair value will be recorded into other comprehensive income. Okay, moving to example 6.8, the facts in the Saru Berhad as per example 6.7 are retained, except now the bonds are now classified by the company as a trading security and therefore classified as a fair value through profit or loss. On 31st December 2021, the market interest rate for the bonds with similar risk is 7%. Required determine the following: A. Carrying amount for the bonds on 31st December 2021, and B. The gain or loss arising from the change in the fair value of the bonds. So based on this question, it already stated that the bonds are now classified as a trading security. So that means that the company have intention to sell it instead of collect the contractual cash flow, so that it have to be measured at fair value through profit or loss. The fair value have to be measured at the market interest rate given, which is 7%. Okay, it is fair value through profit or loss. Why? Because it is classified as trading security and the fair value have to be measured at market interest rate, which is 7%. So first thing first, the thing that we need to do is we have to calculate the expected cash flow by using the coupon rate 6%. The coupon rate is the interest rate that bondholder are expecting to get every end of the year.
So that we will calculate the 6%, this 6% from the principal. Principal is the amount, the cost, the value that we paid when we acquire the bonds, when we purchase the bonds. So that the principal of the bonds is 1 million, which is they purchase 10,000 bonds times with 100 ringgit, the value of the bonds per unit, so that we will get 1 million. So the every end of the year, Jisaru Berhad will get 60,000, but at 31st December 2026, which is during the maturity period, Jisaru Berhad will get 1.06 million because it includes the principal. So that in order to know the carrying amount as at 31st December, we have to calculate all these expected cash flow by excluding this one. This one will be recorded into profit and loss as interest income. We will debit bank, credit interest income. In order to know the carrying amount for as at 31st December 2021, we have to calculate the present value of this interest income that we receive from 31st December 2022 until the payment that we receive on 31st December 2026. In order to know the present value of this expected cash flow, we have to calculate it at discounted cash flow by using the market interest rate given, which is 7%. We have to calculate the present value for 31st December 2022, the expected interest income that we receive on 31st December 2002. We're using the PVIF table. We can use PVIF table, or maybe we can use the formula. The PVIF for 7%, 1 year times with 60,000, which is the interest income, expected interest income that we will receive on 31st December 2021. We will get the present value of this expected cash flow, expected interest that we receive. The present value for 31st December 2021 is 56,075. Same goes to 31st December 2023. We will use PVIF tables for 7% for 2 years times with 60,000. We will get 52,406. And for 31st December 2024, we will calculate the present value by using PVIF for 7% 3 years times with 60,000. We'll get 48,978. And for 31st December 2025, we calculate the present value for 7% 4 years times with 60,000. We'll get 45,774. And the last one, for 31st December 2026, we will calculate the present value PVIF 7% for 5 years times with 1.06 million. We will get 755,769. So all these, we total up this for the present value of the interest income we receive from 31st December 2022 until 31st December 2026. The total amount will be the carrying amount as at 31st December 2021, which is 959,003 ringgit. We will not include the interest income received from on 31st December 2021. Why? Because we will include it on profit and loss instead. We record it as interest income. Next. This is on the table form. This is on table form. For the year 31st December 2022, the cash flow expected is 60,000. The discounted market rate is this, times with the cash flow expected, we will get the present value. This is for 31st December 2023, 60,000. The discounted rate with times with cash flow expected, we will get the present value this. And 31st December 2024, we'll get the cash flow expected 60,000. The discounted rate times with the expected cash flow, we'll get the present value. So all this, we total up this thing, we will get 959,003 ringgit, and this will be the carrying amount as at 31st December 2021. For example, 6.8b, for example 6.8b, we have to calculate the gain or loss arising from the change in the fair value of the bonds. So in order to know the gain or loss arising from the change in the fair value of the bonds, first thing first, the thing that we need to do is we have to calculate the changes between the principal and the fair value. The principal that we pay during the acquisition date, the value of the bonds, and the fair value that we calculate before, which is this, the carrying amount as at 31st December 2021, which is 959,003. Okay, the changes between the principal 1 million minus with 959,003, we will get 40,997. And these changes, this loss, will be recorded into profit and loss. The journal entries will be debit loss, P&L, 40,997, and credit investment of that instrument, 40,997. Next, for example 6.9, the facts as per example 6.7, the Saru Berhad and Part B are retained. For example, the market interest rate for bonds with similar risk is 7% at 31st December 2021. Determine the fair value of the bonds at 31st December 2021 and the gain or loss arising from the change in the fair value. So first thing we need to do is we have to calculate the fair value. But as the market interest rate is similar, which is 7% at 31st December 2021, the same as before, we need to calculate the fair value at 7%, and it is we have to remeasure it at fair value through other comprehensive income. Why? Because it already stated here that the facts per example 6.7, the Saru Berhad and Part B are retained. For example 6.7, they want to collect the contractual cash flow, and for example 6. And for Part B, they want to sell it. They have intention to sell it, so that when both of the objective, which is to sell and to collect the contractual cash flow, hence they have to measure it at fair value through other comprehensive income. So this is fair value through other comprehensive income because I have intention to collect contractual cash flows, have intention to sell, and it have to be measured at fair value, which is at market interest rate 7%. similar as before, we have to calculate the fair value by calculating the expected cash flow, and then calculate the discounted cash flow in order to know the present value of this expected cash flow as at 31st December 2021. Okay, the total amount from this present value of the expected cash flow will be the carrying amount as at 31st December 2021, so that the fair value of the bonds at 31st December 2021 is 959,003 ringgit. Next, we have to calculate the gain. The gain or loss arising from the change in the fair value. So in order to know whether the company receive gain or also loss, we have to calculate the changes between the principal value and also the fair value. The fair value is here 959,003, and the principal value is 1 million, which is the amount that we pay, the value of the bonds that we pay on the acquisition date. So this difference, the loss, it is loss because the principal value is higher than the fair value. When the fair value is lesser than the principal value, then that company get loss. So the difference which is this loss will be recorded into other comprehensive income. So the journal entries will be debit loss in other comprehensive income 40,997 and credit investment of that instrument. That's all from me. Thank you. I will pass to Farida.
Now moving on to the derecognitions of financial instruments. Derecognitions refers to removal of an asset or liability from an entity's balance sheet. Derecognition questions can arise with respect to all types of asset and liabilities. For financial asset and liabilities, when instruments are derecognized, the measurement shall be different between carrying amount and the consideration received, and it must be included in the profit and loss balance sheets. So, why are the financial assets are derecognized? So, if the rights to the cash flow from the asset has expired, we need to derecognize the asset. Meanwhile, for the recognitions of the financial liabilities, when the obligations in the contract is discharged, cancelled or expired, the financial liability shall be derecognized. So lastly is disclosure requirement, which is IFRS 7. So why does disclosure are required? So the objective of disclosure itself is to provide user useful information. IFRS 7 requires certain disclosure to be presented by category of instrument based on IAS 39 measurement categories. Certain other disclosures are required by class of financial instrument into classes of similar instrument as appropriate to the nature of information presented. There are two main categories required for disclosure, which are information about the significance of financial instrument, which is the element under statement of financial positions and statement of comprehensive income. Lastly, information about the nature and extent of risk arising from financial instrument, which are elements under quantitative disclosure, qualitative disclosure, market risk, credit risk, and liquidity risk.